Today, as promised, we are going to go over call walls and put walls, what every options trader needs to know. I literally wrote this out as if I was talking to someone. Uh, so bear with me if there's it sounds like you're talking to what you're reading sounds like literally like if I was typing and writing at the same time. Typing and talking at the same time. We were gonna do this tomorrow, however, I figured I'd get it done today because last night a lot of people wanted to know about how we use this for trade, so let's just dive into it. Call walls and put walls, what every option trader needs to know. By me, the Agent Trades, aka JP. The basics. What are we even talking about? All right, so you're getting into options trading, and you keep hearing about these wall calls that I keep talking about, and everyone just keeps seeing, oh, there's a call wall, there's a put wall. So basically, let me break it down literally like in normal people conversation, right? So basically, oh, this literally sounds exactly like I talk, Jesus Christ. So, so basically, I want you to think of these walls as huge piles of open options contracts that are sitting at a specific strike price. Okay, and we call them walls because, like an actual wall, they block price movement. Okay, um, or at least they make it a hell of a lot freaking harder to push through. Right. That's the fundamentals of what this stuff is. So when you hear people saying, "Oh, there's a wall at 155 on the call side, there's a wall at, 130," you know, these are just areas where there's a large amount of contracts, of OI. Think about it like that. Okay? So, call walls, when you see a ton of call option contracts clustered at one strike, okay? That's your call wall. So from my experience, again, this is me, these typically form at psychologically important price points, like Apple at 200 or SPX at 5,000. Okay? Most walls are built at psychological levels, right? Is that everybody gets that? Okay? So, put walls, it's the same idea but with puts. There's large clusters of put options at a specific strike price. These often form where big players, aka whales, are placing their protective puts. Okay? So, and we know that there's call walls and there's put walls, right? So we can always say that these are always going to be at key areas. Okay? How do I find these walls? Well, I start my morning by looking at the options chain, as you guys have seen me do so, and going through my watch list, right? I'm specifically checking on open interest. And when I see a strike, okay, with 5 to 10 times the open interest of the neighboring strike, that's my cue to pay attention. So, if something has 100, okay, we have an open interest at 100 at one price, and then above it, there's an open interest of 1,000. That's going to catch my attention. Okay? Look, I'm not claiming to be a psychic here, but these walls have saved my butt more times than I can count. And I'm being dead serious, dead ass serious about this. Right? And I'm using an example of when NVIDIA approached 950, like or before it did the split. I don't know why I put earlier this year. Everyone was like, everyone in my trading group, everyone was like calling for the thousands. But then the wall turned out. It turned out that the stock, when the wall, when we hit that wall, it literally almost turned all those positions to pennies, right? And the people who took profit while others were hoping that it would break out didn't, right? And this was, and it wasn't earlier this year. This is like before the split. right? This is when the split happened, before the split happened. Everyone was looking at that thousand, and then it didn't break through, and those calls. So we knew that there was a wall there that we couldn't get above, right? So that's an example of how you find those walls, because there's all that crazy interest at those weird levels, those psychological levels, and if you can't get through them, the rejections are really, really, really ugly, right? And everyone here has traded where they're seeing a potential breakout, and then they don't know that there's a wall there, and then suddenly price rejects, and it doesn't just reject, it rejects violently. So your premiums can easily go from being in the money, right? Or not in the money, but being in a very substantial profit, to suddenly, boom, they almost become worthless, because those walls will push price down violently, or those walls will push up violently, aka the infamous rejection or the infamous bounce on options, right? Is everyone with me so far? Did I lose you? Can you participate in the live sessions other than Kerpal? Okay, so let's put it like this. What these walls actually tell you. In plain English, here's what you can learn. One, these walls are where big boys have planted their flags. Institutional money leaves footprints. Okay? They literally, institutional traders always leave a footprint. Retail traders don't, but institutional traders do. Potential price targets. Love it or hate it, option strikes act like magnets sometimes. Have you guys have heard me talking here multiple times about my bull and bear magnets? Has anyone ever recall me talking about that? And if you have, and you trade with us, then you've heard me saying there's a bear magnet here, there's a bull magnet here. Most of the times, those coincide with walls. Okay? So everything kind of has a relationship one to another, right? Funny story, funny fact for that matter. When price is very close to a daily SMA, you'll normally see walls being built on the option chains on whatever is the closest price to that uh, daily SMA. Okay? Is everyone with me on that? Does that make sense? Because, for example, I took this trade because there's a bull magnet to the 50 SMA. Okay? And there was a lot of options activity around the 75 strike price, okay? At a lot of the week, 2 weeks out, 1 month out, 75 is an area where there's a lot of interest. And also on the level twos, there's a lot of 75 sell orders, okay? So when you start to put all those things together, you can kind of come to the conclusion that 75 is going to be a hard wall to break, right? Because you can see it on the options, you can see it on the level twos, and you can see the block orders on the level twos that are ready to sell at 75. So we all know that at that point, 75 is going to be a wall. And we're going to do our best to get to 75 on for our PT, but we're probably going to get out before it gets to 75, because what you don't want is a perfect example of I was talking about Nvidia. Let's assume this was Nvidia and this was $1,000 strike and everyone was chasing the thousands when it was trading at 1,000, and you got right up to the price and then boom, it wicked off violently, right? That's funny, newbie. That's that's your you said a funny, and it's supposed to be happy hour. So again, we have to understand what these walls are signaling to you. Again, I'm not psychic. I'm not telling you that this is going to be 100% effective, just like I don't tell you that the MOs or the MOCs and the imbalances are 100%, witchcraft, but they work to a certain degree. Okay? So, we talked about it. Potential price targets, love it or hate it, option strikes act like magnets. Where price might hit a brick wall. We just talked about this. There are areas of interest in particular underlines that when they get to a certain place, they have a tendency to reject hard if they do not break through it. Everybody knows, I've talked about this multiple times. If Palo Alto Networks does not go above 187 with a strong break, it rejects and then it decides that it's going to be, a little girl and drop all the way to the 170s again. Okay? Here are the mechanics of why walls actually work. Here's what your YouTube gurus don't explain properly. Okay? Excuse me. When price gets close to a call wall, market makers who probably sold a lot of those calls start hedging by buying the underlying. This can actually help push price towards the wall. You just called me out. Yes, I did. But once you reach the wall, something interesting happened. All those calls at the strike, they create selling pressure. When people who bought those calls start taking profit. So these are the bastards that you have to be careful with. Right? That is why we do not believe in doing what? It starts with the letter C. Come on. You guys can do it. CC. Copying. No. God damn it, Purple. Chase. You don't chase. Okay? Plus, market maker hedging requirements change. It's like hitting a ceiling. It's very important that you guys understand this. I would highlight this entire sentence if I were you. And I'm going to reread. Oh, you suck. You suck. You know that? You really suck. How do I unhighlight this? Oh, I'm going to lose my mind. I'm going to lose my mind. What? Okay. Thank you. Yeah, it was driving me nuts. So you should highlight this. The hedging requirements change. It's like hitting a ceiling. Guys, I cannot emphasize this enough. When you are in a trade and you see walls, these walls are there for a reason. You are not the Lord, your Savior, Jesus Christ, Mohammed, Moses, or Tom Cruise, or Ron L. Hubbard, whatever you believe in. You are not going to be the one that breaks through the wall. There has to be reasons why you break through that wall. And it's not going to be you. Most people will try to see a wall break and they chase it. And they're like, oh my God, I'm a genius. And then it comes right back down underneath it. And they're like, oh my God, I'm an idiot. And then it comes right back up and then it goes nuts. And they're like, oh shit, I suck. Yeah, you do, because you should never be chasing, period. Okay? I learned this the hard way in Tesla 2021. Bought calls expecting a breakout above a wall, only to watch price bounce off of it like a basketball. Cost me a few grand in the process. Lesson learned. I tried trading a Tesla breakout, thinking that I knew what the hell I was doing because my buddies, my friends, my market participants that work at UBS and Stifel, those guys, right? They're gonna try to break the wall, right? Yeah, I put a couple of grand so I wouldn't feel bad about myself, right? You will never ever try to be part of wall breaking, okay? Once you lose a couple $1,000 on a trade in less than 30 to 40 seconds. Because remember, the rejection on these walls, right? The rejection on these walls are violent. They're very, very violent. So remember to use this as a guide to understand when I am getting close to a wall, I want to exit before I get to that wall. You'll hear a lot of really, really good traders say, I'm getting out right before I get to my level. Because if that trader found that level, I assure you that there are 99.999% of other traders that actually have that level as well, right? And everyone is probably waiting till it gets a couple of ticks from within that wall to get out. That's why if you're trading a 75 call on Uber, for example, right? You don't, maybe you get out at 73.99. Maybe you miss 50 cents on the trade. But I'd rather be safe and get out before I get there, right? Than keep getting the juice squeezed out of the contracts and then suddenly out of nowhere at a blink of an eye there's that random 30 seconds in your life where you decided it'd be fun to drink some water and you spit the water out because the dumb thing dropped $1.50 in front of your face. And that has happened multiple times. Alessandro, who's in the room, who's changed his name to Kerpal, and if you're old enough to remember who Kerpal is, it's from a comedy skit courtesy of the Jerky Boys. Anybody? Nobody. Seriously? Does anybody know who the Jerky Boys are? Moving on. Real examples, and let's get specific. I can't believe nobody knows who the Jerky Boys are. Let's just use this example, okay? These are examples. Last month, Apple was trading at 190. And checking the chain showed that the call walls, okay, there was a call wall over 35,000 contracts at 200 strike, compared to 5,000 or 6,000 at the surrounding strikes. Put walls, about 28,000 contracts at 180. What happened? Apple bounced between these two levels for a week. I sold calls and 180 puts and collected premium while everyone else was trying to predict direction. Both expired worthless. Easy money. This is an example that I took from something that Kevin or Tom. Okay? Kevin, do you mind chiming in here? I would love to use you for a second. So I just gave an example of how these walls are example of how you would trade a spread.
Correct, yeah.
Okay? So these walls were telling you where there was a call wall and where there was a put wall. And you could have benefited from both sides because it traded inside of both of a range. So you could have gone long whatever price it was trading at and seen it go to 200 and make some money, or you could have gone short and taken to 180. But since it traded inside of that range, you could have taken advantage of understanding where the put and call wall were and played both sides.
Yeah, absolutely. Just like sometimes I use that for my iron condors.
So this type of knowledge of knowing where the walls are allow you to trade spreads properly.
Yes.
Do me a favor, don't get off the mic.
Oh.
Tesla, a playground for wall watchers. I came up with that all by myself, by the way, because I was going to say whale watchers, so wall watchers. Get it? Seriously. Okay. You guys fucking suck. Tesla at 250, call wall 275 over 2,200 contracts. Put wall 225 around 18.5. My buddy Jake ignored. I didn't say. I replaced Jake's name with someone else. Tom. My buddy Jake ignored the 275 wall, bought calls above it, and I watched them bleed value for weeks. Meanwhile, I was selling iron condors between these levels. Something boring is profitable. This is a perfect example. My buddy Jake, I know you're laughing, Kevin, because we know who that is,
Yeah.
was trying to catch breakouts because he's a genius, but it didn't work in his favor. He ignored the wall. The wall bled him to death. Walls will bleed you because, again, they're trying to catch a breakout. Let's talk about SPX, where real money plays. Real money plays. This is where it gets serious. When SPX has walls, you better believe it matters. Last quarter, SPX 5150s, call wall, absolutely massive, 5200. Put walls at 5,000, another put wall at 5100. What happened? The index chopped around 5,500 range for weeks. It was selling weekly iron condors and making consistent income while directional traders were getting destroyed by theta decay. These walls allow you to get into these type of option trades. By selling weekly iron condors and having these walls, you can make consistent income. When these walls are that big, you can take a directional trade and you risk the wall, maybe perhaps in the middle of your trade, moving, right? From 52 to, let's say, I don't know, it decides that it's going to be fun to move to 5150 because those walls can move really quickly. That is where advanced options trading helps you take advantage of these walls. Kevin, do you want to add anything to this?
No, I'm pretty sure you literally covered that spot on.
Okay. The psychology, why this works. Here's the thing. These walls become self-fulfilling prophecies. Big money creates walls initially. Retail traders, that's us.
I got
Thank
it.
you. Retail traders, that's us, see the wall and expect price to respect it. We expect price to respect it. Doesn't mean it's going to. We all position accordingly. Market makers do their hedging thing, because that's what I call it. And voila, price behaves exactly as the wall predicted. It's not magic. It's market mechanics, and you can exploit it. Okay? I'm going to pause here for a second. Let's assume, okay? Let's assume for a second that we are in a situation where, let's assume that we're in a situation where we see weekly expirations that are building walls at 75 for Uber. Let's assume that then we go 2 weeks out and we see more wall building at 75. Let's go out a month and you see more walls being built at 75, right? Everyone's building walls at 75. You have confirmation that there's a wall at 75, blah, 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 blah. Price is trading at 68, 69, 70. You already know that for some rhyme or reason, 75 seems to be an area that they want. They're telling you they're going to take it to that area. So if they're going to take it to that area, right? That means that you've received a signal that that is where they want to go. They've literally signaled the market and said, this is where we're going to go. And because this is where we're going to go, you can then say, okay, I know I'm probably not going to get above 75. I'm seeing that they build walls at 75. I can tell that everybody wants 75. Let me look at the put side. Where are they building walls? They're building at 68, 69, 67. So we know that if I look through all of the chain, I should have some consistency and support. So I now know that they're going to trade me in this 10-point range or this 11-point range, but I'm trading midpoint right now, and I can tell that there's volume going in, and I can see that we're going to move to the upside. The call wall is letting you know, literally letting you know, that real money and big money wants to go there. For whatever reason it might be, maybe there's some dude on an institutional level that needs to get rid of 3 million shares at 75, or maybe 100 million shares at 75, or maybe 5, whatever the amount is. That guy has already called all of his boys and said, I got a 75 bid at, 100 mil, you know? So everybody already knows that this guy's going to sell at 75. So every single institutional trader or every fund is going to create that flow and get retail to the point where, guess what? That particular individual can hit the sell side and dump the shares on you, because you might be down $1 on whatever amount of positions you have, right? That's irrelevant. You're down $1 on 100 shares. You're not going to lose you're not going to go crazy. But these guys have X amount of shares and every penny counts, right? So the walls will guide you. I want to skip through this because I went back through all of my trades, right? And I went to my E-Trade Pro and I started looking at some of these Amazon trades that I would take when Amazon was trading like at ridiculous amounts. But let's just skip through that because it's pointless, because I already discussed an example with Uber. So we understand, right, that we are going to use these walls as guides. Now again, they serve as bull magnets, they serve as bear magnets. It doesn't mean that they're going to be fulfilled. But it does mean that this is a place where we're probably going to go. Okay? How to actually use this stuff. Here's my typical game plan. You find the walls first thing on Monday morning. Walls will start to build. You set alert at prices approaching major walls. You can either sell premiums, call above the walls, put below the put wall, look for breakouts. When price has tested a wall multiple times, right? Position size appropriately. I go bigger on trades with wall support. When I see massive wall support on a trade, okay? Massive wall support on a trade. It's going to be really hard to get me out of that trade. Really, 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 really hard to get out of that trade. Today, I had to learn the hard way. Coca-Cola was a trade that I took yesterday and I swung it into today. Kevin specifically told me, make sure that you don't freak out if this trade goes below, if it breaks and closes below 70.54. Well, it just happened to be that I was watching this all day. I was up a little, down a little, up a little, down a little. Kevin gave me this level. Fed Williams decided it would be fun to come and speak and decided that he was going to ruin my life by saying that inflation was going to be at 3.5 or 5% and that he was really, really worried. Not to mention, the University of Michigan sentiment 1-year inflation expectation went up to 6.7%, if I'm not mistaken, and the 5-year went up to like 4.7 or whatever it was, 4.7. So I freaked out. I freaked out because I even called Kevin. I said, Kevin, I'm screwed because if this is real, Coca-Cola is going to start raising their prices on all their products, and their profit margins are their profit margins will eventually go up, right? But I mean, they might slow down. And imagine, like, you're already paying $2 or $2.75, whatever it is you pay for Coca-Cola, but they have to raise it to whatever it is now, $3. That's going to make a hell of a difference. And I immediately told him, I'm like, I think I got to get out of this. And he's like, oh, you got it. I wouldn't. Wait for that 54. Where was it? 54? Was it 70, 54, Kevin? Is that what it was? Yeah. Sure as shit. Sure as shit. This guy comes out and starts talking, boom, it goes down to the level. And I literally sent out a message saying, I got to get out of this at 10% because I think this is going to drop. And then this thing ripped this way. I let my feelings get in the way. When I went back into the options chain, there was so much support on the 70 calls, so much support that I completely erased the idea of me checking to see where support was built. And I let my emotions get the best of me. To then later have this rip. I got into the trade again and I got out at like 13 or 14%, but I took a 10% loss, which I shouldn't have because I failed to do what I should have done, which was stop, make sure to check what the hell I was doing. Were there any, where were the put walls? Where were the call walls? Where was support? Where was resistance? And I didn't use what I should be using as a guide, right? Because again, I let my emotions get the best of me. Stuff nobody tells you, frequently asked questions. Do these wall works for all stocks? Hell no. You need liquid options. Don't try this with pennies. Stick to names with volume. Okay? Just because you'll hear a lot of people trading penny stocks saying they're building a wall here at 25 cents. You cannot build walls at 25 cents, my guy. There are no walls. Penny stocks, sub $1, even sub $2, 3, 5. There's no walls. Anybody can blow through them. So don't let anybody tell you anything on penny stocks that, oh yeah, there's a wall being built at 17 cents. They're bullshit. Complete bullshit. So please ignore that, right? Because right now we're talking about options, right? But let's talk about the walls that are being built on the level twos on penny stocks, non-existent. So don't fall for that. How much open interest constitutes a wall? Well, it depends on the stock, but rule of thumb for big indexes, 20,000. For Apple and Amazon, 8, 10,000. Okay? Look for things that are 5 to 10x the normal OI at a strike. Kevin, can I ask you a question since you're here? I like to say 5 to 10 times more, but sometimes you'll see that there's a lot less than that amount. Would you still consider something that's 2 or 3 times the normal amount of open interest a wall?
Yeah, I mean, it really depends on the option chain, right? Like you'll have option chains like let's say Alta, or not even Alta, Visa, right? Visa is a very good option chain, but sometimes you're going to see that there's just going to be low liquidity on it. But that doesn't mean that, some strikes in the option chain that have unusual OI compared to the other options is something that's not worth looking at, right? So, yeah, 5 to 10 times works really great, especially for the liquid option chains. But if you go to an illiquid option chain, not too illiquid, but mega cap or big cap that just has a little bit low liquidity at a certain point, I think just if you spot something, especially on monthly expirations that are just unusually high compared to the other OIs, then it's worth keeping an eye out for. Like, for example, let's say if the average OI on most of, let's say, May 16 contracts, which is in a monthly expiration, let's say you see around like 200, 400, 500, 600 kind of like OI, and then all of a sudden one of the strikes has like 1,500, then, that's something, or 1,000, something like, that's just something to keep an eye on. But it works more for, as you said, the more liquid stuff, because then you're more certain about it.
So if anyone wants a real-time example, Frank just posted on the live sessions chat an example of where those walls are on a particular underline. And you can see exactly what I'm referring to. Now, Betty just asked a question, so let me go ahead and answer this when we get to it. After this question. Do walls change? Yes, all the time. I've seen walls disappear overnight after earnings or any news. This isn't a set it and forget it analysis. I check walls weekly at a minimum. At a minimum. Okay, especially like if I'm in a monthly trade and it's something that I believe in, like Kratos, I wasn't checking the wall every day. I wasn't checking the walls on Lambridge because I knew where they were building, where they were stacking, right? But can they change? Absolutely. It's not something that's dead set. So keep an eye on that and stay focused, right? Because it doesn't necessarily mean that because you see it today is going to be there tomorrow. So it's something that if you're trading something that the price action of it by memory or by heart, most of the time you don't have to be checking it. But if you're in things that you've never traded or that you don't really know how it moves and you have like maybe a weekly, which I don't advise trading, or more so a monthly, check the monthly. If you're in a monthly contract, check it once a day. See if price action is mandating the direction of where you're going. See if they're pushing the wall up. Sometimes they're pushing the walls down. The best thing that can happen to you is suddenly you're, let's say, again, Uber, you're in a 75 strike for 2 weeks out, and that's where the wall is, and then suddenly you see that wall get thin and they move it up to 80. Does that make any sense? Yes, no, maybe? Nobody's typing? Feel like I don't have anybody here? Okay. Are monthly expiration walls stronger than weeklies? In my experience, yes. Monthly walls, especially at key price strikes, can influence price for the entire month. Weeklies matter more as expiration approaches. Once again, the guys that are here, the guys and gals, know that Kevin and I, and the majority of the people that we trade with, we like trading maybe a month out, 3 weeks out, but mostly monthlies. Okay? Because of the volatility that we're in right now, weekly walls can become very irrelevant. And for the people that have been here for a while, remember when we were talking about where the VIX call wall was and where the VIX put walls were? Does everyone remember that? The people that were here? Those were a month out. And price got to those monthly call walls. And in the weeklies, it just acted erratic, right? But it went for that price target on the monthly call walls because that's where they wanted it. Okay? So monthlies are a lot more important. Does this still work with fast moving markets? I just answered this. It's less reliable in major market events or crashes, but they're still relevant. During COVID, I was living in the Netherlands. and I was trading from the Netherlands, and SPX blew through walls, right? But would often still react to them briefly before continuing. Briefly before continuing. So in moments of high volatility and in very fast moving markets, walls can become very, very dangerous, because if you sit around and you sit there and you're saying, oh, it's fine, I don't care, I got this, because it's gonna bounce, this is a level that I love, it's gonna go. No, absolutely not. Do not use walls as a form of entry other than to try to catch a quick bounce if you're daring enough during psychotic news events. I don't even want to. How many people got their face ripped off this week trying to catch bounces on SPY? Hey, it's okay. Thousands of people, millions, if not hundreds of thousands, whatever it is, went through that. Every single wall that SPY had got knocked out. Every single wall. Because there are people that don't understand the concept of bear flags. Oh, went right to a wall, boom, bounce, it's gonna go, and then it bear flags down, boof. Oh, it hit another wall, it's gonna bounce, boof, it goes up a little bit, oh yeah, it's finally gonna go, boom, dumps, and goes right through that wall. Do not use walls for highly volatile stocks right now in this trading environment. You can use walls to trade kind of less dangerous things like Coca-Cola or General Mills or Kroger or something like that in this environment, because yes, granted, everything got slapped in the face 4, 5, 10%, but on a normal day, if the market is dumping, the safe stuff isn't going to get whacked that hard, right? So keep in mind that they can become very unreliable during major market events. Right now, we are in an environment where major market events, okay, are an everyday thing. One of the people that we trade with calls Donald Trump the mango, God, I forgot what it was. The mango prince, right? The mango prince can come out at any time and change his mind. We saw the S&P go nuts on Wednesday, go nuts on Thursday, and today kind of just stagnate. So keep that in mind. Are walls more important? I'm sorry. Are walls more important for calls or for puts? Put walls tend to be more reliable supports in my experience. I think it's because institutions use puts for protection more than calls for speculation. Just my 2 cents. When I was trading my very, very big account, I would trade puts as protection against my equity position. Okay. I wasn't speculating positions with calls. If I liked the setup on an equity position, I'm sorry, on a stock position, I would put my money to work. Okay. Look, I'm not promising you the holy grail. I've had my share of trades where walls didn't hold, but understanding these market mechanics has completely changed how I trade options. Take what works for you, test it out with small amounts, and see if it improves your results. I want to stop here really quick. I received a bunch of messages from people when I gave my market imbalances class on MOOs and MOCs. I'm not pointing at you, Bob. I received a bunch of messages from people saying, I tried trading the imbalance. And I said, why are you trying to trade the imbalance? Oh, because the imbalance gave me this print. It said it was bullish. Okay, what did you do? Oh, I took a position on SPY. I bought SPY calls for the next day. And I sit there and I question, like, if anyone ever listens to what I say, if you've never traded a certain specific style, why are you putting money to work? If you've never done something, why the hell are you trying it with real money? What was so hard for you to grab a pen and a piece of paper and say, I am going to buy SPY calls at this price because the MOC said they were MOC said they were long, and this was the price. And then see what happens tomorrow if that trade would have worked out. But instead, I have 4 different messages from 4 different people saying that they learned about the market imbalances, they thought it was genius, and they took trades. Only one of those persons actually worked out, which congratulations. The other 3 did not do well. They came like negative 70, 80% on their options. And they were upset. If you've never traded using walls and don't understand the concept of how walls work, why would you then take this and run with it and use it as something new? Why not grab a piece of paper, grab your pen or your pencil or your crayon? I don't know. Maybe you're weird and you like to write with Sharpies or blood for that matter. And you just write it down. Hey, there's a wall here at this level. Let me see if it holds. Okay, it held. If it would have held, and I would have it holds, whatever it is, right? Let's just say it holds that wall. And let's say again, that wall is $50. And you said, okay, I want to go long. I want to go long at this wall because it's holding it. Okay, I want to buy 55 strikes. Okay, I'm going to paper trade it. These strikes were, I don't know, let's say $2. It held that wall and it went to 55. Whoa, those contracts went to $7. Okay, cool. Oh, I did a good trade. Oh, well, you did it on paper. Oh, yeah, but it doesn't feel the same. I'm going to repeat a line that I've said multiple times that I learned from my mentor. When he first started at UBS, he went to his MD, his managing director, and his managing director said, why did you take that trade? And he says, oh, because I felt good. And his managing director said, the last time I felt something, I got gonorrhea. So do not take this theory and then, and you know exactly who it is, Kevin, and so does Nightingale. So you know exactly who that person is. So don't go ahead now and because you're going to go to the options chains and you're going to be like, oh my God, there's 75 gazillion contracts at this price. That means that. No, you're not going to do that because that's not what you're going to do. Because since you've never traded this style, which is very simple, right? It can come back to bite you. And what do we learn about simple ideas? They tend to be the most complicated, right? Why do people jaywalk? It's so easy to not cross the freaking street. And then they complain when they get hit by the random Dutch person on their stupid bicycle in Amsterdam when you're walking around Vondel Park. Not that that happened to me multiple times. So, again, please don't use walls as signals for trading without experimenting and paper trading and trying it first. Remember that sometimes the best trade is no trade at all. I'd rather miss an opportunity than lose money ignoring a wall that's clearly signaling danger ahead. Happy trading, and may your stops never be hunted. I came up with that by myself, by the way. I did all of this by myself. So I'm going to close this for a second, and I'm going to move on to something very important. I did not take any trades all of this week up until yesterday. I took my first trade. The only trades that I took, I think I took a Bank of America trade, which made 40%, and I forgot what else. I've only taken 3 trades this week. Okay. Sometimes the best trade, and Coca-Cola, that's true. Today, yesterday. Sometimes the best. So I traded Monday, Tuesday, didn't trade Wednesday, Thursday. Yeah, okay, there we go. So Thursday into Friday. So sometimes the best trade is no trade at all. There was multiple signals that I got because I also go into my options chain and I put alerts, right, on the options that I want to watch. Okay. And they start going off whenever I see them, right? So what ends up happening is there were so many alerts that I got on possible trades, but I didn't take them. And then when I did see them, I went to the options. I'm like, oh, damn, dude, there's a massive wall here. They're trying to take price here. Oh, shit, it's going to go. It's going to go. And it didn't feel right. Something didn't feel right. It wasn't feeling natural. It felt like I was forcing a trade because I was scared because of anything that could happen. Because the Mango King or Prince, aka Donald Trump, right, can say anything at any given point. So I wanted to get through all of this stuff. I wanted to get through CPI. I wanted to get through PPI. I wanted to get all of this crap out of the way, right? Even though I was seeing huge areas of support and resistance, because I don't want to have 3 days of chaos ruin my entire week, or for that matter, take away all the money that I've made from last month. So sometimes the best trade is no trade at all. Is it hard? Fuck yeah, it's hard. Does it suck when you see a setup and you don't take it and then it could have made you 100% or 30% or 40%, whatever? Of course it sucks. Does it suck when you're looking at the options chain and you're trying to trade, let's just say Palo Alto Networks, and there's a huge support at 150 or 155, and you're like, damn, I want to take this trade, but I don't know what's going to happen because anybody can come on TV and say whatever whatever fucking shit they want is going to ruin it. And I could have taken the 175s and I could have made a shitload of money and I wouldn't need to trade for the rest of the month. And do I sit there and hate myself? Absolutely. But what would have happened, even though there was a wall there and it was serving as support, and something would have happened where this guy said something that would have gone the opposite direction of it and it would have blown through $1,000 of my money. Right? That is why when there are volatile news events and we are in a risky environment, call walls can, to a certain degree, almost become irrelevant. Use call walls as another form of confluence, or just use walls, period, to use it as another form of confluence to make sure that the directional trade that you're in is serving a purpose. Use the walls so that you understand if you have stop losses at the right part. Here's the funny part. People don't take the time to see where the blocks are, right? Blocks or the walls are. And they'll put their stop a couple of cents above the wall. If they don't know that there's a wall there, they just put it there because the price felt right. and then price dumps, hits their stop loss, and goes into that area, and then does it catapults to the opposite direction of the trade. It catapults in the direction of their original position, and they're like, "What the hell did I do? What did I do? What happened? What did I miss?" Well, you probably missed either a level 2 block order that was sitting there as support, a huge wall on the options chain, or you didn't have your areas of support and resistance drawn out. And then you feel like a dumb fuck. So getting into any position and getting into any trade at any capacity requires you as an individual to use all of the tools that are available for you to understand if you're going to be in the right side or the wrong side. Walls, like anything, serve as confluence. So use them to your advantage. It's that simple. It's not complicated. Someone will sit here and tell you that, oh man, this is a super complicated way of understanding how it's not. Don't fall for any of that stupidity. It's very simple. The only thing is that you just don't have to treat them like a golden ratio or whatever, like a for sure thing, like anything in life. Nothing is for sure. But they do serve a purpose. Does anyone have any questions? Okay, first question. Why do they become walls though? If institutions are buying a bunch of strikes, wouldn't it signal that there is going to be a potential move in that direction? I'm just confused how to increase. Sorry, I'm just confused how the increase in open interest creates a wall for share prices to not pass it. So why do they become walls if institutions are buying a bunch of strikes? Wouldn't it signal that there's going to be a potential move in that direction? I'm just confused on how the increase in OI creates a wall for the share price to not go past it. I mean, you can unmute me. Yeah. I'm I feel stupid because I'm trying to understand what you're asking me.
JP, I understand the question. I'll rephrase it.
Thank you. Can you answer it then?
Yeah, so the confusion is maybe not totally understanding what happens. So like when you let's say you buy a call, you don't just buy something, somebody's on the other end of that. So you buy the call, you have a right, if you want, to exercise the option to get the 100 shares. Well, those shares don't just come out of the blue. Somebody else is on the other side of that option, and they either have the 100 shares or more likely they need to go buy them at that market price. So that's why. So like if you buy a call, there's a pretty good chance you didn't buy it from me. You probably bought it from a big bank or somebody who's on the other side of that, or market maker or whatever. They probably didn't buy those shares most likely to hedge the option. They kind of just wait till it gets there. So what ends up happening is that let's say you buy a 110 call and the stock's at 100. Well, maybe they don't buy them at 105. Maybe it slowly bleeds its way up to 110 slowly. And then it gets there and they go, oh crap, well, we might have to come up with this. So if they have shares, they will then sell those shares to try to push so you're literally fighting the market maker. And that goes into the whole gamma situation. But so just assume every time you buy an option, there's somebody on the other side of that doesn't want that to play out.
Okay. Thank you for answering that because I had a hard time understanding the question. I feel dumb now.
Well, JP, so the one thing I would try to really hammer home is people need to understand how options work. Like they need to know what it means to own an option. Like forget all the price movement stuff and whatever. Just understand that actual mechanic. Like when you buy an option and you exercise it, what happens? And it's pretty simple, but most people just don't bother to learn it. And once you learn it, it makes total sense. And it kind of makes learning everything else really easy.
Yeah, so you guys have to understand that you have the right, not the obligation. Everybody gets that, correct? We all know what options are and how they function.
Yeah, I get that like you're allocated those shares once you're exercised. I was just confused how like if a big institution is buying a lot of strikes and there's a huge open interest, say like Apple 150, there's like 8,000 open interests on it, that becomes a wall because someone is trying now to prevent that from being exercised. Is that what you're saying?
Yes. So a lot of times what will happen, and we did something on this before, it's on the YouTube channel on Gamma. So a lot of times what happens is when you just see kind of stair-steppy price action, that's usually just big money. They're actually just spamming the call button. That's all they're doing is they're just spamming buy calls, and they're forcing market makers to keep having to hedge those calls that they're buying. Well, eventually market makers have to buy enough shares that it kind of gets to what you call the call wall, which is where the highest open interest is. And market makers usually look at that and they go, okay, well, you just made us buy like 10% of the stock price for the shares. Let's just sell them there and see what happens. Right? Because then they maybe don't have to lose money on that side of the trade.
Oh, okay.
Yeah. So that's why the gamma is so important to identify. Because when you're in positive gamma, that's when like prices it's like choppier, but it kind of just fades in directions. But what we've had just the last couple of weeks is negative gamma, and there's no preemptive hedging going on there, right? It's just level dumps, and they're already hedged, and suddenly the whole the trap door just opens, and suddenly those walls become they become not walls, they become like jumping out of a a plane with an anvil for a parachute.
So, Alessandro, you're not muted, are you? Ale, are you here?
Yeah, I'm here.
Okay, so remember how I told you that these sons of bitches will trap you?
Mm-hmm.
Okay, so they will literally, don't you dare quote me on this one, okay? They will suck the life out of you, okay? So you suck. I hate you, right? They will literally suck you to that price, right? And you're like, oh man, like, it's gonna happen, it's gonna go, it's gonna go, it's gonna go. And then like Tom said, out of nowhere, they literally it's like, they drop an anvil, and it's poof, it just goes. So what they'll do sometimes is they'll build walls, build walls, build walls, build walls, build walls, right? And keep building walls and walls and walls and walls, and like you know what they'll do? They'll create a baseline at a wall, and they'll put another wall above it, and then another wall above it, and then they'll erase the price underneath it. Tom and I have seen this before. So let's just use an example. There's a wall at 50, they wipe it, and then they move to 51, and retail chases. Then they wipe the 51, they move to 52.
JP, I have the best example. Pull up SPX with the JPM collar on it and show how that long put that we have right now. Show how it's like a magnet. It's literally like a price magnet.
Oh yeah, that's a good one. We've talked about this. There it is. Look at if you're looking at my screen, can you guys see what I'm seeing? Just to confirm, can you see my SPX chart? Can you guys see my SPX chart? I just want to make sure. Okay, here's a perfect example. Look at this. We got the August lows. Boom. JPM put collar here. Bah, gets whacked. Revise the JPM target. Comes back up. Whacked. Down. Whacked. You see how it's literally price gets attracted right to it. And there's a lot of people that chase this breakout. Right? They'll chase this breakout. And then they get smoked. Let's go back over here. And go to the 30-minute.
Well, the reason I wanted you to pull that up is because it's a long put position.
Mm-hmm.
Whoever they bought those from are short those puts, so they're on. So JPM's on the bearish side of that one,
Mm-hmm.
and whoever they bought those from are on the bullish side of it. So imagine you're on the bullish side of the trade, and the markets are just collapsing, right? Well, what you're gonna do is you're gonna defend that like with your life if you're a big market maker. So it's important to understand that every time it goes below that level, until they run out of money, they're gonna, or until their risk profile changes in some way, big money, whoever's on the other side, that is gonna defend that as much as they can. That's kind of why if that level were to have like rejected and dropped, kind of like the last caller did, I mean, you'd have like an epic plunge. I mean, I don't know how many contracts that is. You can probably find out pretty easily on Twitter, and just times those contracts by 100, and that would be how many shares. I bet it's in the ballpark of $5 to $10 billion worth.
Probably,
Just,
if not more.
and that's just JP Morgan. That doesn't account for any other big money that chased that trade or whatever. So when you look at it and you go, well, why is the market so sticky and choppy right now, right? Kind of around. It's because you have money trying to break that level, because you'd hit a massive flush if that happened. But you also have money on the other side of it that wants to defend that because they're short those puts, right? They want those puts to go to zero.
Yeah.
So when you buy options, you're literally, it's literally just tug of war, like the game, right?
So the funny part is, everyone was saying, speaking of which was why I keep emphasizing how important this JPM collar is, and looking at the SPX options chain to see where the walls are. And the guys that trade with us will hear me in the mornings, and I'll be like, yo, they're building walls right here. They're doing this right there. We're building here. Careful, careful, careful. And people are like, holy shit, it's to a T. Because the options chain is showing me the walls of where these wonderful people are trying to put price and stick it in between. And you better believe that these motherfuckers at JP Morgan, they refuse to be wrong. If anyone saw the price action that happened today, yesterday, from here to here, when they were trying to break this out, and you could see the institute, at some point you can recognize who the market maker IDs are, because it's almost like there's no way this is this market maker ID, like whose code is this, right? JP Morgan, because this is JP Morgan, they defended this area so well, this 5310, and you should have seen the breakout traders that were trying to get this JP Morgan trade out of the way. And let me tell you, when they smoked the calls, oof. And it's funny because they smoked them all the way to the revised JP Morgan target for the S&P, for the 2025 revised S&P target at 5,200. And you could see the same market maker ID flip long. Same market maker ID flipped short here. So these guys, you got to love them because they're just sitting there and they're playing with you. So when the market gets rangy like it does here, right? When it gets rangy, like when it gets there, you better believe that these guys are having a field day because they're going to protect this right now. Now, don't get me wrong. Suddenly, you'll see these call walls move up, and JP Morgan then is forced to try to defend their position as much as they can. But the other institutional traders, the other money flow is flipping bullish. They're going to defend this position with their life, which is why you're going to see a lot of commentary saying, the market kind of feels like it's just trading in a range. I think a lot of people underestimate how much money JP Morgan contributes to the stock market. Tom, are you here?
Yep.
Yeah. I think is Vanguard, was Vanguard $3 or $4 trillion worth of the stock market?
Something like that, yeah.
Vanguard was like 3-4 trillion. I think
BlackRock, State Street, and Vanguard are the three big ones, and then Susquehanna, Citadel, Morgan Stanley, Goldman, I think.
Yeah, and JP Morgan, I think, is like the $900 billion worth of money into the market. Okay, there you go. 657 billion. They got 657 billion. We know one guy that has 20 of that billion, by the way. He's a moron, just letting you know. He lives in New York. Think about how much money they're throwing to defend this. And you better believe, man, I can almost guarantee you we might have a little continuation pop, but these sons of bitches are not gonna let this trade go against them. Tom, what happens if this trade starts to go against them and suddenly they get squeezed out?
Which side?
The long put collar.
Okay, so the thing is with JPM, so I'll do this quick. So when you have a collar, essentially what you do is you short some calls at the low end, and then you short some calls at the high end, and then you buy a put in the middle. And you do that when you hold equity, because what you do is you buy the put collar, like the put that you buy is not always, but it's usually your average price that you own the equity at. So what you're doing is you're saying, well, I don't think it's going to go any higher than this level. It's definitely not going to go any lower than this level. But if it goes below the price that I bought it at, then I'll make money. So basically, no matter what, you make money, but it allows you to kind of play in a box, essentially. So with JPM, for them to make the most money, they want it to be under the calls they shorted, under the put they bought, and and then you have a put at the bottom that you're bullish on. So you want it to be above your lowest level, but under your two. So if you go back to ES, just go back to March 31st or so and look for, I'm sorry, I don't remember if it was, no, SPX, I'm sorry. And go to, what was the last caller? 5565?
Something
like that?
I don't have the last caller. I don't have it.
Yeah, I know. I just know it off the top of my head. It was like 5565 was like the middle of it. And the reason it's called a collar.
Yeah, it was 5565, and
in case you're just kind of like a visual learner, the reason it's called a collar is because the put that you're short way down at the bottom, the one that you're basically saying that will not go any lower than this, that's like the bottom of the shirt. And then the call that you're short at the top is kind of like the neck, and then the put's like the collar of the shirt. It just kind of looks like a shirt. That's why they call it that. But so if you go to 5565 at the end of March, they that 31st, I kind of joked to you and Kevin, I think, maybe even Randy, like I think it was on like the 29th. I was like, how much you want to bet like they go to take this collar or something out, or they go to JPM goes to take, bank on their collar right at, expiration.
They did.
And it kind of did. And that was just me I was just kind of making a joke. Well, I wasn't like super serious, wasn't like, look at my call, but you can see what it did.
Yeah,
like once that broke, and then they got a new collar, suddenly all that level that had to be defended just disappeared, right? And the market just went gap, crazy moves down. So that's why the options levels are they're super important, but at the same time kind of not, because the big ones matter. And what's really more important is to see if those levels move or not. Because when you have the VIX at 60, the VIX is like super easy to tell what options are doing. When the VIX is really high, it's telling you that options are very expensive. So when things are very expensive, you sell them. So that's why the market's very rangy and choppy right now, because the real money-making play is short the calls at the Trump pause high and short the puts at I believe the Monday AM low. So what they're doing is they're basically just shorting all those calls and those puts, because the market's really not going to make a move that big. And because everybody's net short the options, the market makers are now long calls and long puts, and hedging means you do the opposite.
Mm-hmm.
So if you're long puts, you're going to be buying, right, the equity. And if you're long calls, you're going to be shorting because you want to be neutral. And that's why when you have big money who's buying and shorting at the exact same time on every option that comes through, because the big money is all selling or they're all shorting them, that's why you get this choppy movement that's just kind of meh. It just doesn't go anywhere or do anything.
This is where walls come into place, because here's the other thing, right? You can have let's just say you have a call wall at 55 and a put wall at 52. You're just basically being told that you're gonna get fucked sideways.
Yeah, and
Yeah.
that's the market balancing itself out. So if you ever see like a bull flag form, if you ever need to kind of like visualize this, so you have a bull flag, you have the big flagpole made, right? Volatility goes up a lot, call options go up a lot. Well, eventually it stops going up, and then volume falls off, and then it kind of forms the flag, and it sells off a little bit, but on lower volume. So what happens is those calls start to lose value again, lose value. And then eventually it bottoms out. And when it bottoms, you can notice the options, then the IV go up on them again. And now suddenly you're not selling calls, you're now in a position to be buying them. And good traders will see the bull flag and buy calls. And now suddenly market makers are now, right? They're now short calls. So they're in a bearish position. So what are they going to do? They're going to buy. So now you're long and the market makers are now buying the bull flag up to hedge their position. So when people see these big explosive moves come through, I mean, that's not like some guy who sat there and said, I'm going to buy the top. That's not what that is. That's either some guy who was short that got smoked on equity, or it was market makers just hedging their positions, and that's where the breakout comes from. So if you see the flow and you see a lot of options being bought to open, it's probably a good sign for volatility. You're going to get big moves, and you see a lot of options being sold to open. It's probably a sign that you're just going to chop around. Or you're just going to be range bound.
So Alessandro says, he goes, I totally understand. And if I told you what I actually thought a lot of open interest meant, you would shoot me. And I'm curious what you thought it meant. Can you unmute yourself? Because you don't have to be embarrassed. I mean, a lot of people don't know what OI is.
So I mean, when I saw big open interest, the first thing was like, okay, if there's a lot of open interest, that must mean that a lot of people think that that's the direction the share prices are going, and someone knows something that I don't.
Well, that's not wrong. If you see a lot of open interest, like if you're trading like a momentum stock, like I kind of got Palantir back months ago, if you see a stock that has momentum in either direction, long or short, and you start seeing the open interest start to climb the options chain, right? That can be a good sign, because that can tell you people are getting more bullish right as it goes up. That also just means that when it finally stops going up, right, the longer that goes on, the bigger the crash is. So yes, you're not totally wrong. Yeah, you're not totally wrong.
Okay. Yeah, look at JP trying to embarrass me.
I have a question for you guys.
Give me 1 second, Tabitha. I want to answer this guy's question. Van W. Where do you see option flow of buying? Sorry that I was sorry if I already asked this. So, whatever. He's just asking, where do you see the options flow? Is that level 2? No, level 2s are the order books. Okay, flows, you can see them on different services, like Unusual Whales shows you the flow. some brokers offer flow. E-Trade Pro does not offer flow. Does anybody have a broker that shows you the flow? Okay, I've never used Webull, so I wouldn't be able to tell you. Okay, so I look at things on the options chain, and I have an option in my E-Trade Pro that allows me to see a particular set of option activity. So I'll get alerts on key things that I have selected that will tell me, if there's big option buying, if there's bull sweepers, excuse me, or bear sweepers. So yeah. I just want to get through this. I can't even see that because I don't have my glasses, Van W. But is anyone that use Webull, can they click on that and see what that says? I have no idea.
I'll take a look. 1 second. Just,
Yeah, I left my glasses downstairs. I only
is this
have my
in main chat or is this in
it's in the live sessions.
chat? Okay,
I only have my computer glasses, which
like this.
are for UV.
Yeah, so that's going to show you. So on Webull here. So this shows you. Okay, this shows you open interest. It looks both ways and volume, and the pulse index, volume, put call ratio. Yeah, so that's going to be pretty good for the most part. The only thing it's not giving you for information is whether those options are open to close or sell to close. And to me, I think that's really important, but I mean, it's not like the end of the world if you don't have it. You can usually imply it too.
Those are I need to get. Okay. So Tabitha, what was your question?
So, in the credit spread, like iron condor kind of example, you were talking about how put walls and call walls can be indicators of where it's safer.
In very volatile trading environments. So walls will get blown right through.
Yeah, it has to do with the implied move. So I would disagree. I wouldn't say. I mean, I guess it would depend on what tool you used. I wouldn't say we were in negative option gamma right now. I'd say it's definitely positive gamma. And the way you can tell is if the VIX is at like 60 or even 50, options are going to be like super expensive, which means you're going to need like massive moves. This is why you hear when like people go to play earnings on a stock, like people would always play like earnings on like Upstart or something. And it would have like an implied volatility of like 250%, right? Well, that means you need to get like a massive move depending on what the option premium is. So what's happening is the VIX has gone from 60 to I think it's like 37 or something right now. So that's good if you want to play options, like if you want to buy them, you want to be long. And it's been good if you've been a seller of options. So the way to understand it is if the majority of money, not people, is the majority of the money is in the hands of the minority of holders, right? So it's not the majority of people, it's the majority of the money is going to be net short options. I mean, if you look at where that bottom is on SPX or NDX, I mean, that's pretty far down there. And you kind of have two kind of higher lows. So if you're a big money institution, you're not going to be buying calls because you'd have to get back up to the top basically just to make any money. But you can short all the puts and you can short the calls up there on both sides because the range is so big. I mean, we're like I think we're like 5-6% away from the top right now,
Mhm.
and we're probably like 9% away from the bottom. And if you just look at the VIX and if you look at the options, the implied move is not 5. So like think about it this way: the options are priced. They're priced for like a 10% move, but the actual move that's implied that you're probably going to get on a day-to-day basis is like 2 or 3%. So it doesn't mean it's free money. It's absolutely not free. But the math is telling the computers at the big funds, hey, there's like a 0% chance this trade goes against us if we just short all the options. So they're shorting them. And these market makers then are being forced to buy these options, which are just like literally going to go to zero. So they're going to take the opposite trade, right? They're going to, okay, this guy shorted a call, so now I'm going to buy it, I guess, from him.
Mhm.
And okay, well, now I'm going to be buying all this equity. And then somebody gets bearish, right? Or I'm sorry, somebody gets bullish, so they're going to short the puts. Well, now I'm long this put, and now I'm shorting all the equity, right? So that's why, like, so it might seem like negative, but that's why I say a lot of times you don't even need a tool. If you're just stuck in a range, it's positive gamma territory, because positive gamma is supportive and negative gamma is amplifying. So that's the best way to kind of think about that. So if the VIX is at 60, you don't want to buy options, you want to sell them. And you just kind of run that little logic puzzle through, and you can just go, okay, big money shorting. So market makers are just going to be supportive, right, of the market. They're not going to let it break down too much. They're not going to let it break out too much. And that's kind of what we had today for the most part.
Hey, no,
Mhm.
one quick thing, because I gotta head out in a second. So when you guys were talking about the Webull and the Robinhood thing, yes, that's useful information, but keep in mind that's just option statistics. The best platforms to show option flow, which is different from option time and sales and option statistics, is as platforms such as JP said, Unusual Whales. Again, we're not sponsored by them in any way, but Unusual Whales is pretty good. I've heard of Blackbox. There's also Cheddar Flow as well. Tradieticks if you like that, but that's kind of like overpriced. Um, I personally use Unusual Whales. I like Unusual Whales as well. And the most important thing, similar to what Tom said, is you need to make sure you understand if the flow that comes in is for the ask side or the bid side, right? Because of course you could sell and buy options, right? And there's two sides to everything. So you need to figure out which exactly is happening because that changes the whole sentiment of the flow. So you can find that and filter it out on Unusual Whales where you can have it where it only filters in the ask kind of option flow, right? Which doesn't mean 100% of them are on that. Like if you get ask trades for like calls, right? That means people are buying calls. Versus if you get bid on calls, that means people are selling calls. That doesn't mean on a filtered Unusual Whale option flow where you just have ask filtering in. It doesn't mean that 100% of those orders are people buying in options to enter. It could also mean that they're closing it. So you want to keep that in mind. But Unusual Whales is a really good platform. Maybe one day we can do a live session on that. I don't know.
Ooh, that'd be fun.
Yeah, and we could probably put up a link for Unusual Whales if you want to use our affiliate link to support us. But yeah, Unusual Whales is pretty good. But what you guys have on Webull and Robinhood is not option flow. That is just option statistics, and it doesn't show everything that you need to be looking at when it comes to option flow. Just want to make sure that gets whatever thingy. Thanks.
Yeah, I guess I would love that Unusual Whales session because I guess that's where I was getting the negative gamma. Like, like they said the gamma was negative on Unusual Whales, and that's where I look at the gamma levels. So I guess maybe I'm reading it wrong, or I don't like fully understand what I'm looking at then.
Was it for daily or weekly or like monthly, or did they have like
Yeah,
a date range on it?
so I just pulled it up just to kind of double check my memory and hang on. Let me make this bigger. So they'll do a daily gamma. They do one for different strikes. They do one for different dates, and then they do one for strikes and dates. And when I go to net gamma on every single one of them, except for maybe like the 0 GTE from today, the net gamma is negative.
Okay, so that's because you have the monthly expiration coming up here in like a week or so.
Okay.
So it's you have to be able to compartmentalize, right? So it's like, okay, negative gamma. It's like, okay, because like what has happened in the last month, right? It's like, oh my God, like huge drop, right? I guarantee you a lot of put sellers were offsides on that one. And you didn't make any money on calls, right? So the only people that have open positions are going to be the people who shorted calls. So, so essentially, it's kind of being able to compartmentalize, like, okay, here's what's happening on the monthly, here's what's happening on the weekly, and then today, how's the setup, right? And then a lot of times you can look at like tomorrow, and you just kind of go like, okay, like I don't do this a lot anymore because I'm gonna be honest, like once you use it a lot of times you can just kind of see it on the chart. So like, because the big thing is a lot of times with the option wall levels, a lot of times those are just your support and resistance levels. It's really common for those two things to be the same thing. So what I would do is I would, although use the tool for sure, I would make sure that you agree with the tool. I mean, I'm wrong a lot, but I don't get so upset at myself when I'm wrong. I tend to get mad at myself when I kind of thought I was right and I went with somebody else's idea, and then it ends up being wrong. So you can kind of just see it in the chart.
Yeah, I mean, I definitely start with the charts, and then we'll kind of go back and forth with, the gamma levels from unusual whales, and then a couple other things that I like to look at. But I definitely noticed that when we were going down and when we were definitely in negative gamma territory, it was the levels that I historically could reasonably expect to be respected and see price dollar or reverse or whatever. Like that was just not happening. So I was kind of like, how do I read this in this environment,
Yeah, when you think negative gamma, just think people are offsides. That's the best way to think about it. Like imagine you have a big stock market crash coming, like just hypothetically speaking. Let's just say you had a really big crash about to happen and you're going to the very first support level. Like that's probably not going to hold, Like it's safe to say that those people are offsides. So that's kind of what negative gamma means. And positive gamma means everything is priced in and the world's perfect and in harmony. It's kind of like an accumulation kind of area or range usually. So just keep that in mind.
I want
And
to,
then that also happens to the upside too, right? If you're not.
Yeah, negative can be to the upside or the downside. It's just way more common for negative to be to the downside because markets spend usually 80% of the time going up, staircase up, elevator down. So that's why you tend to see negative gamma in, it shows up the most to the downside because that's usually when the most people get caught up. Like most people don't get short squeezed, right? But most people buy too high and then it dumps and then they, that's just kind of how markets work for the most part.
so Achilles asked that question about if there was another place to see the OI data. We already answered that one. NASDAQ level 3 has flow. You can buy it directly from their website. And then there was an unrelated fact that apparently live options data is available for free for everyone in the Indian stock market. That's very interesting. Before we kind of wrap up this conversation, then if there's anything that anybody else wants to ask, I'm happy to answer it with whoever's here. I want to point out something very glorious that's happening. So today, the MOCs decided that it was going to be a fun time at Richmond High to go along the close, and this was the imbalance that we had. It's right here. You all can see that, which is why we can see that the S&P started to really have some movement to the upside. But notice that even though that imbalance came in on the positive side, right? You really didn't feel it here, right? You really didn't feel it. So it makes you wonder if these guys, the market on close orders for the S&P, really are going to have any steam going into Monday. Now, here's the funny part. There was already a death cross formed on the S&P today on the EMAs. And we're probably 1 or 2 days away from the S&P forming its death cross on the SMAs. Remember, the EMAs get ahead of themselves. So they're already signaling that something is going to happen. And then we already know once those SMAs cross, holy hell is going to come out. I want to go to the last time that we had a death cross. So that you guys can understand the violence of this move. So, it takes a few days, guys. It doesn't happen immediately. Here was March 22nd, March 22. We had a death cross signal. Notice how the market popped, comes right back up, closes above both SMAs, creates bullish momentum, everyone gets trapped. The death cross happened down here. You get your pop. But then, holy shit, all hell breaks loose. This move from here to here was 1,000 points, the S&P. This is going to be the first time we do this. Fucking mosquito. Sorry. This is going to be the first time we do this in a very long time. In almost 2 years. Is anyone shocked by this? What do you mean, regardless of tweets? I don't understand what that means. I'm going to continue. So, this is going to be the first death cross we've had in 3 years. What I'm expecting the S&P to do is this. I'm expecting it to try to come up a little bit more. We'll have a couple of days of relief, maybe up to Evercore's target of 5,600. Assuming that this happens, this is when I think that the S&P comes straight back down to retest this low down here. Okay? Now, we're not saying that this is going to happen, but you have to be aware that death crosses, when they occur, they happen for a reason. We can even go further back. Let's go to historical information. And the last time we had that death cross was when? It was here. That was March 14, 2022. That was the last time we had a death cross. We had a death cross here. Market was pushing down, but notice that it reversed course. These can happen as well, okay? But most of the time when you have a death cross with this type of volatility, it can get really nasty. Here's another example, death cross, rode the wave down. But it wasn't as violent as when this one happened, which was back in 2007. There's a reason why I'm pointing back to 2007. What is the biggest fear that we are having right now in the market? Can anyone compare 2007 to 2025? Can anyone talk about the actual reality of how this looks in comparison to where we're at right now? Can anyone? Notice that the S&P had created a new high for the first time in a long time. Came back down, came back up. Started trading up.